The Little Book That Beats the Market by Joel Greenblatt. Welcome to yourbooksummary.com. Why the magic formula works. The magic formula looks at two things: companies that make a lot of money compared to how much they invest, and companies that have low stock prices compared to their earnings. This formula works for big and small companies. The idea is to find companies that are doing well but are priced lower than they should be. Companies with a high return on capital are usually strong because they have something special that makes them different. For example, Apple's iPod is popular because it's easy to use, and Coke's brand is well known and trusted. These companies can keep making money by investing in what they do best. By focusing on companies with a high return on capital, the magic formula avoids investing in companies that aren't doing as well. This can help investors during times when the stock market is unpredictable. Sometimes the magic formula doesn't work for a short time because the market is unpredictable. But in the long run, it usually works out because the market eventually recognizes the value of good companies. So, investors don't have to worry too much about losing money over time. I hope you found the information about The Little Book That Beats the Market by Joel Greenblatt. If you're interested in learning more about the book, stay tuned for the next part of this series where we'll dive into the next section. Thanks again for watching, and I will see you in the next video.